Let's get some perspective on the IT sector. Rahul Jain, Vice President Research at Systematix Shares and Stocks, is now joining us. Rahul, what would be your call on the IT sector now? You think valuations are looking decent, or you would still wait for some bad news before you would want to buy these names?
Independently, if we see, the valuations are definitely attractive, but I think the more relevant parameter given the scenario is PEG, which take care of GP in context of the growth that we are anticipating. So currently for the large cap, this range is anywhere between 1.5 to 2.2 for the tier 1 stock, and for mid-tier it is anywhere between 1 to 1.5 times. So I think this is an optimum range would be around 1.5 for large cap, and around 1 for the mid-tier. That has been the case in last couple of years. So that would be the point of choice for us. So either the growth rate visibility should improve and we may be okay with the current valuation, or the valuation should come off for make it realistically attractive going forward.
But as of now, it's in a zone where you cannot do anything?
No, so we have chosen some of the names where we see there is a good potential of earning growth on a PEG basis, and those are the stocks where we are comfortable. Unfortunately, none of the large cap qualify for that at the moment.
You're getting a lot of news flow regarding layoffs into IT companies. Do you think that will help their margins, or it's just because of lower business that they are doing that, and that's why it'll just get adjusted in the utilization rate?
I missed your question.
What I'm saying is that a lot of layoff news is coming for the IT sector, for the large IT sector in India. Do you think that will help the margins?
I don't think layoff in individual term is a meaningless data, because it has to be seen in terms of what has been the mix, and is the layoff is there on a net basis overall, and how they change. Are these going from the automation kind of zone? So there are multiple factors, and I don't think it is a pure cost which is driving this. I think it is the performance and the mix of the people you actually want in your team. Those are driving this kind of layoff. Cost pressure is marginal aspect. The other two aspects, in my opinion, are more relevant.
Right. Just in terms of dividends, buybacks, the payouts that these, or we can say capital allocation that these companies are doing, will that make it look attractive, or it's too early to take a call based on the capital allocation?
So I think especially FI's point of view, given their lower cost of equity, I think these tools are helping to sustain the valuation, because growth rates are coming off, visibility is low, but still the prices are holding on because of overall comfort around the net return, where the capital return would be less, but dividend or adjusted EPS through buyback would make it attractive. So I think those are important tool till the time we come back to some respectable growth rates.
What would be your top picks right now in the IT pack?
So large cap, we are strict on with the TCS from the tier 1 league, and in the mid tier we like Oracle Financial and Emphasis, and in the small cap we like Ramco Systems. So two of our ideas are software play, not services play, and the other two are services play, where we see the earning growth and stability on volume.
Right, but do you think that mid-cap IT is the area to focus? So, there is still a lot of value versus the large cap names, because growth rates could be meaningfully higher?
I don't think there are many mid-cap which are giving a very clear indication of very high growth for next 2-3 years.
Right, so you would just stick to these names?
I think based on our coverage as well as soft coverage, I think these are the names where we have comfort right now.
Just a word on the rupee. Say if rupee stays where it is for the next year, there could be some downgrades on earnings?
I think there are a lot of currency movement that has happened, and which is definitely leading to a lower PAT growth versus top line growth in this year. So any further cut or even a sustained average basis, there could be a marginal cut in our overall estimate. But I think currency would not be a driving factor, because more important is the volume growth, because currency keep on moving in either of the direction, and it has defied economics in past, so we never know how sustainable the current level is. So I think our call is more on the business. Currency may just add up a little bit of comfort or discomfort.
Do you look at Just Dial?
No, I have not seen it.
Mr. Jain, thank you so much for taking out time for us. Good to get a perspective from you. That was an IT sector view coming in. Of course, the sector has been a big underperformer of late. Let's look at some companies that are reacting to their numbers. So let's just pull up the stock of SBI.